Most people don't fail financially because they don't know what to do. Stock market's easy. Buy low, sell high, right? Well, let's find out what sort of hitches you might run into if you are an emotional investor. Hi, everybody, and welcome to another episode of Dollars and Cents, Hapo Community Credit Union's Financial Literacy Podcast. Today, rejoining us in the studio, we have Tyler Pearson and Nick Haberling, both financial advisors with HFG Trust. Gentlemen, welcome back to the podcast.
Thank you for having us back, Scott.
Yeah, happy to be here.
Absolutely. Today, we are going to take our last conversation, and we're going to dive a little bit deeper into what a market mindset means, and how people may not actually be helping themselves out when it comes to investing, stock market, those type of things. Because most everybody has a pretty decent base understanding of what the stock market is. Buy low, sell high. That's easy, right? So how come everybody, I shouldn't say everybody, how come people run into problems when it comes to investing? Is there a situation where, say, more knowledge is a bad thing, or is it that there is a different psychology that comes along with investing in something like the stock market?
Yeah, so I mean, I think more knowledge is a funny way to put it, because I think people like the idea of having more knowledge, understanding things, at a higher level. And while I wouldn't say that more knowledge is what hurts, but I would say that a perception that you have more knowledge than you might have about the stock market is probably where people really get into trouble.
The Dunning-Kruger effect.
Yes, exactly.
The more you know, the more you realize that you don't know enough.
Exactly. And I think the stock market's can feel like the Wild West a little bit to some people, but this idea that you know what's going to happen, and if you have 100% conviction that you know what's going to happen, I think that sometimes is a little bit of a red flag for me, and it's a place where people kind of get themselves into a little bit of trouble.
Okay, so it's the kind of thing that if you would prefer a client working with you that understands that they don't understand everything.
Yeah, and I think curiosity is a positive thing. I want them to want to know more, but I would be the first one to say that I don't know everything, but I know enough, and am able to hopefully tap into kind of the psychology of what it looks like to be invested, to hopefully point people in the right direction.
I was going to say, with those clients that come across as if they know all the things, do you feel like that type of client ends up being a backseat investor to a point? Like maybe they should just go get a Robinhood account and kind of spend their time over there doing some day trading type of work?
Well, yeah, I think it'd be kind of like, if you're a basketball coach or mentor, it'd be kind of tough to work with a player who, thinks they already know everything about the game. Then it's kind of like, why are you the coach? Kind of, the conflict or mentality that happened between like Phil Jackson and Kobe Bryant, sort of the start of their career, what have you. And kind of with those clients, then becomes a question of, is there maybe some sort of behavioral management, or not necessarily that term, but putting together guardrails like, hey, is this the money that you want us to invest? Within this framework, this academic evidence-based framework that we have, that is humble with our understanding that, hey, we don't know everything about the markets. That's why we're not active stock pickers. And then here's your fun slice.
Yeah, honestly, I think that feels like the type of thing. If you get somebody who believes that they know everything that's happening, they get involved in trying to micromanage those decisions. Does that feel kind of like where things happen? People get a little twitchy. They don't do the standard wait and see type of approach that most investing tells us is a successful route.
Yeah, I think it's certain that the buy and hold strategy, is a proven successful strategy over a long period of time. And I like the way you put kind of quick twitch decision making. I'm a firm believer that emotion drives decision making, and so we see it on both ends. There's, if the stock market's in a bull market and it's been on a good run, we see people that have, their fear of missing out. They want to be in, the hot tech stock or whatever it might be that's performed double what the broader stock market's done over, any given period of time. And then on the flip side, we have people who, when the stock market starts to go down, it's just the fear that their money's going to continue to go down. And we see, quick decisions, panic selling, and situations like that arise on the downside as well. And so I do think it comes back to managing emotions with most investors, myself included.
One thing I want to add is I think saying hey, wait and see and buy and hold presents kind of like a degree of passivity that's not actually there when you're maybe just investing in the index, for instance. So that index still represents, thousands of individual companies who have CEOs and middle management and employees who are, reacting to economic situations. If there's a downturn, they don't, the company just doesn't say, well, the economy's going down. Guess we're just going to wait and see. No, those players, they're all then trying to figure out, okay, how do we increase productivity? How do we increase profits that will ultimately, benefit you as the shareholder? So even if you're not personally doing anything, there are thousands, tens of thousands, even millions of people across the world who are then trying to, react to the situation, to steady the ship, to, increase the value of the stock and react to events.
Now, does this change across different types of investments, 401k, Roth IRA, versus literally just purchasing and owning individual stocks? Are there different strategies that you guys would see across those, or do you guys have a pretty solid plan that you apply across most things?
Yeah, so to begin, probably to preface things, most of the time when we're talking about this, we're going to be speaking from the perspective of someone who, is very diversified, using, sector or country specific ETFs or mutual funds. If you're an individual stock picker, a lot of this stuff, may not exactly pertain to you because, we'll talk about fight or flight is hey, 60% of stocks over the long run are actually underperform treasury bills. And so if your stock that you're picking is going on a downturn, it might stay dead. and because you don't know that, you don't know how these events are going to play out beforehand. That's why we're saying, okay, we want to be an index investor. We're humble where we don't think that people, can see the future perfectly there.
Yeah, Nostradamus, as well known as they are, if one of those people existed today and could literally read the market, they would be probably the world's first trillionaire, making those moves regularly. And we don't have one of those people that any of us can reference, at least not that I can.
No, exactly. And so what I would say is, while our opinion on our investment strategies are universal, across the type of accounts. Depending on someone's situation or the type of accounts they have, because some are treated differently from a tax perspective. We might say, hey, this slice of the pie should go in the Roth account, this should be in the IRA account, and this in your typical brokerage or joint account.
And then, of course, that small percentage of the you go have fun with this account, this slice of the pie for your own big brain day trading investment strategies, or your passion project, if you will. Hey, here's a company that I really believe in, or a slice of industry that I really love and want to support with the couple $1,000s that I've set aside for me playing with to see what happens.
Oh, exactly. So I just look at myself. I'm not an individual stock picker, but I enjoy SpaceX, and even though I have no idea what the future of the company is, if they ever IPO, I'll probably have a little tiny piece.
See if that gets you a seat on a flight one day.
If Elon won't even ride his rocket, I won't.
Now that is the wait and see mindset for sure.
Yeah.
Is there a situation where people feel like that you have encountered where people feel like if they're not being active with their accounts, that they are being irresponsible?
Yeah, I see that pretty frequently, actually, especially in the 401k world, because, as you might know, 401ks kind of have their own parameters in terms of what you're allowed to invest in. And frankly, it encourages to a large extent a long-term holding type strategy. And so I have people all the time that say, oh, it's, I'm not doing anything with it. What do I need to do? And I think the way that Nick explained it earlier is really the best way to explain, how passive investing really isn't as passive as you might think. The beautiful thing about passively investing in the stock market is you don't have to do anything, right? It's not like if you manage a rental and you have to go, check on the tenant, make sure it's filled. You are, to his point, you're funding, you're investing in a company, you become an owner, and then you have a CEO that handles the middle management, who handles the lower management, who handles the employees. And I think that is what's so cool about, passive investing, is that you still have effectively people that are out working, to try to build profit for a publicly traded company.
How much of that investment shifts between those different indexes over the course of years? Or is it literally like I'm buying into one index and it's just going to sit there and wait? Does that index shift who they invest in? Is it being active, as in trading ownership of different parts of different companies while I'm not doing anything?
Yeah, that's exactly it. So an index, so important is meant to talk about is like, hey, an index could just be tracking a specific sector, a country, or a global. And then when we say an index is that particular fund that's tracking the index, it's not making its own, like the investment managers behind there, they're not making their own opinions, like saying, I think NVIDIA is going to be great, so I want to have more of that relative to this. They're just saying, hey, this is the percentage of tech the NVIDIA's weighting in the percentage of tech companies. Let's say tech makes up, I don't know, something trillion.
A large number of dollars.
Yeah, and then we'll say, hey, NVIDIA's weighting is naturally 10% of it based off of the number of shares and the price per share. We're just going to have 10% of it. That'd be an index approach. And then what's really important then is, as an investor, is like, hey, do you want to be invested across sectors, across countries? That'd be our opinion. And so if you looked at a global market cap weighting, the United States is sitting at about 60 to 64% of the value of the world's publicly traded companies. And so then that's where we start off. And then, investor could then argue one way or the other.
Okay.
Yeah.
But so in that, then it's just a broad spectrum. You're buying a little bit of everything, weighted by the percentage of how much. So in this particular scenario, 60 to 64% into American companies across all the countries, and therefore leaving 36 to 40% in foreign investments in some way, shape, or form. But you're not picking any specific things, such as like if we say go into the tech industry and you're investing in a group that is just in tech, and they're not shifting like 10% up to 12% of NVIDIA in the middle of this. They're just saying, we're going to take 10% of this one.
Yeah, no, that's a good way of looking at it.
Okay. So do you feel like people then confuse action or movement with progress or profit?
I certainly, have seen that be a confusing kind of, I guess, subject. I don't know if that's the right way to put it, but I certainly have worked with people who feel if they're taking a lot of action, that they are making progress, regardless of what the initial results are showing. And I do think it's kind of human nature. If you're very involved in something, if you're working on the day-to-day of it, even if things maybe are sliding, you have an explanation, maybe for yourself, maybe it's a good excuse for why things are going one direction. Whereas if you're not working in it day to day and you're just letting it kind of go, then when things go bad, you can kind of kick yourself for it a little bit. And
so why didn't I make that move?
Exactly. And so I think that's just a human tendency, and it's something that's important to manage both for yourself and then for us when we're working with clients.
I was going to say, you feel like you've made a move and therefore you can justify the action that you took created a good or negative result.
Right.
But now with the negative result, you know that you did a thing and now you can do another thing to then fix that. Whereas sitting and waiting and be kind of like, I'm going to go ahead and plant my vegetable garden and then I'm just going to let the sprinklers do the work to water this thing over time, as opposed to me going out and constantly being like, ooh, well, I need 3 more drops of Miracle Grow to make this actually do something. Where kind of a Schrodinger's cat situation. If I did something and I see a change, if I didn't do that, would I have seen the same change or a different one even?
Right. Yeah. So, I mean, I think what's challenging with investing in particular is just that, this is a 30 to 40 year project where oftentimes the most important decision that you made was to get started on it, and then committing to those periodic reviews to make sure you're making the right amount of contributions. Has your situation changed to where now we have a structure to make a change to the investments? Most investment changes aren't reactionary to necessarily market events themselves outside of a pre-made plan. They're more attuned to like, hey, what's going on in your life? Has an inheritance come in? Has there been a death in the family? Those kind of events.
Major life changes.
Yeah, major life changes. Some we can predict, such as, hey, you're going to have Medicare or Social Security here soon. Some that we can't. And so I would say the biggest decision is, committing to that routine.
Yeah, definitely not looking at the clickbait headlines or the sensationalized media that says, oh my goodness, the stock market had a major crash today. And you look at it and you realize it's just today and it's still up over the course of the last week. But it was this, they zoomed in the graph. Now you've got this giant fall, feels like the cliffhanger event in The Price is Right.
Yeah. Well, then I think the biggest concern is like with the financial media or just a lot of media in general is you as the audience or consumer of it don't just always right off the bat know what the person's intentions are or their motivations. One person's could be, if someone's like just selling you gold or crypto, for instance, their motivation could just be, hey, I'm just trying to collect as much of your assets and money as possible to earn a fee, and I don't care whether it makes sense for you to own 50% of your investments in gold or not. Like, I don't care if that's a wise decision.
Or I'm a major owner in this company, and therefore I'm putting out this article that says that they're the next great thing that's on the rise. Everybody else should invest in this as well.
Right. Exactly. And so, when someone's being interviewed on CNBC or whatnot like that, you have to just keep in mind that, that they do have their own motivations. They could be a private investor in those companies. They could have a stake in the game to where they're saying, hey, I want you to use my product. Don't even know if it fits for your situation, but you should use it.
That's a fairly non-fiduciary type of a statement.
Exactly. That's really the opposite of the fiduciary standard that we are upheld to.
Yeah. Well, when we look at, CNBC is a great example because CNBC is a company, right? And they're designed to make money. And so what's their stake in the whole thing? It might not necessarily be that they own, investments in other companies, but how do they make money? Well, they make money on views, right? And what drives viewership is not boring, kind of broad scheme financial advice. It's like you said, oh my gosh, the stock market's going to crash, or oh, this is the next hot stock. I always see those. It's like, these are the top 10 stocks we're looking for in the next 1 year. And it'd be a fun research project to go back and look at those 10 stocks a year later and see where they're at.
And that's why you can only have us on every couple of months, because we can only talk about the fundamentals.
I was going to say, if we start bringing you guys in on a regular basis, we're going to need to get the soundboard with the sirens.
It'll get real boring.
But I feel like that clickbait headline, that sensationalized thing might go back to our initial idea that more knowledge is not necessarily a good thing. I now know that CNBC is hyping this thing up, but that doesn't mean that I need to do anything about it.
Right. Well, and I think I wish we have a slide that we use with clients that is, the stock market over the last 50 years. And then we actually have, put like major headlines from different dates throughout throughout the time period. And if you look at, if it's the U.S. stock market, you look at it over the last 50 years, well, it's up quite a bit.
Yeah, not shocking.
And but if you read the headlines, make it sound like the world's going to end in several different circumstances. And I kind of equate it to, I see people in the younger generation talk about like what homes are worth for maybe their parents or grandparents and what they bought them for. Mm-hmm. And it's funny to me that, homes, because you don't get them priced every single day the way that public stocks are, people they're not worried about it. It's not that mom or grandma put all this effort in to make their house go from $100,000 to $400,000. The reality is that they purchased a home and then they lived in it for 30 years.
Yeah.
That's all they did. And, it's hard for people to bring that perspective to stock investing. And I think it's largely due to the fact that, we have clickbait headlines, like you said, that are going, you need to get out or you need to buy this stock, you're missing out. And that doesn't exist with homes.
I'm kind of curious if we were to go back. You mentioned having 50 years worth of this, as some of those headlines that exist there. When, this may be a complete left field question, when did day trading really become a consumer type of a activity? Because not a lot of people can go to the New York Stock Exchange and trade stocks on the stock floor, but I remember in the late 90s, day trading became much more of an actual thing for the standard person. I feel like looking at the headlines before that became a thing versus after, I'd be curious how much of that really impacts today's consumer media lives.
Yeah, I think you're spot on there, Scott, where it really took off in the late 90s, early 2000s. And I think a big role of that is just, how effective technology became to lower the cost of trading. So I have a client I worked with who said like, hey, back in the day, I had to pay $200 just to place a trade.
Yep.
And there's one thing, $200, large dollar amount. And then when you think about like the time value of money is $200 in like the early 90s or late 80s when they're talking about. That's even a greater amount of money than $200 today. And then I think about how, just in like 2017, when I worked at TD Ameritrade, one of the larger custodians at the time, trades were down to $7 for each individual stock or ETF. And then before I left in, late 2019, they announced we're getting rid of all commissions involved in that. And so I think when there's no longer any friction, between making a trade, getting in and out, other than whether you were right or wrong. Mm-hmm. What people do forget often is that there are still tax consequences.
Yeah, moving money around is always going to be noticed by somebody.
Yeah, and short-term gains, are taxed higher than long-term gains. But yeah, I think once you get rid of friction, those inherent costs, right off the bat, it makes it easier for people to day trade.
Yeah, and I feel like that may be where a decent amount of our sensationalized headlines come from, where people start targeting, I really need to pay attention to this daily. I know every time my phone gets an update, it wants me to re-add the stock widget to my lock screen. Yeah. And I don't pay attention to the daily movement of the stock market other than through random headlines or social media posts that you're incapable of avoiding. Yeah. But yeah, those I feel like become kind of a thing. Like I knew a couple of people who did day trading and they did pretty well when they were doing it. Oh. But at the same time, like if you weren't paying attention, if you're running a quarter stock and it goes up to 50 cents, congrats, you doubled your money, but it cost you how much to make those trades? Because back then there was, again, like you said, the per trade fee that came along with it. So you got to make sure that you've got enough of it to justify that cost.
Yeah, you gotta cover the commissions, you gotta cover the taxes, and then there's a whole nother cost of, especially if you're not doing something full time. It's like, okay, what else could I be spending my time on? If I have a career, could that be time spent, being better at what my primary job is, and improving that method.
Playing fetch with your dog.
Hanging out with your kids and whatnot. So I have a family member who over the Christmas break kind of asked like, hey, what do you think about like 24/7 trading? I'm like, that sounds like the worst idea. Like I don't know anyone you know, who is
It
in
sounds
investments.
like if you're doing that, I'm going to start investing in coffee companies.
Yeah, you might as well. It's like I don't know anyone who would willingly want to be trading 24/7.
Feels like it already feels like with the open and close, there's so much going on as like how much you would have to put in to be that type of person, and how well you would have to do breaking it down by day or even by week to make a legitimate living doing only day trading. Doing it as an investment on the side with your fund money. Yeah. And I would probably still have a problem looking at that weekly.
Yeah. Well, and then, you know, to the point of like, hey, are you going to outperform, underperform, whatever it is, you have to realize that you're essentially, you know, when you're overemphasizing one company or another, you're essentially saying like, hey, I am smarter than all these people who do this professionally full time, and not only smarter than them, I'm smarter than the machines that they program to, you know, move off of all these price indicators, and somehow I'm going to be faster than the algorithm.
I don't think I'm quite willing to throw any money behind AI as a trading tool yet, but I can imagine that there's a bunch of people out there trying to leverage that to analyze the market trends. And I'm sure that there's a bunch of major companies out there using that as well.
Or machine learning is what we would have called it, like before 2021. A lot more controlled.
So what sort of identities of investors do you guys regularly see that kind of fall into these categories that we've been talking about? The risk takers, the extremely cautious individuals, and how do you see this mindset working for and against them?
Yeah, so I see probably three main categories, and I think you nailed two of them. There's extremely cautious people, very aggressive, risk-tolerant people, and then there's another group of people who I would say they just want somebody that they trust to take care of it, and if they trust them, they're good.
I'm pretty sure I fall into that category where I'm just like, you do this for a living, I don't.
Right.
I'm going to give you money, you make it do the thing.
Right. And I think that the really risk averse, which would be they don't want to take a lot of risk, and then the individuals who are very aggressive, there's not one that's right or wrong, but there is typically, you know, if you can imagine two lines, one's, you know, how much risk you're willing to take, and one's how much risk you're actually able to take to still be able to accomplish your goals.
Okay.
And there's an intersection. Those two lines at some point are going to cross. And so it's important that people align their willingness to take risk with their ability to take risk. And so, for example, I have, you know, clients or have worked with people who wanted to become clients who are getting close to retirement. They have enough money, but you know, they really don't need to maximize their year-over-year return, and they want to be as aggressive as can be because they're just stock market believers right now, and they want to be in tech or whatever it might be. And you know, it's for them, the conversation is, how do we align your goals with your investment philosophy? Because what you're wanting to invest in doesn't align with, you know, what your goals are. And then on the flip side, you have people who are young and don't want to take any risk, and it's walking them through the importance of being invested in stocks for the long term to be able to accomplish long-term goals. So I think those are the two most common, you know, categories. It's just a matter of aligning people's, you know, again, it's risk tolerance versus risk capacity. Those have to align.
Like when we do hit a recession, Great Depression, obviously everybody knows how horrible those numbers were. If you are closer to a retirement age, that is going to be a much bigger hit on your investments than if you are a younger individual who is just starting in. You're going to lose I think the Great Depression was in like the high 20, low 30% range of the loss, if I'm remembering my numbers correctly.
The worst year was high 30s.
Yeah. So like imagine you've got all of your investment in high risk and you lost 35% of your investment right before you're about to retire. This, I think, is what you're getting at with your ability to take risk.
Yeah, no, that's exactly right. And, you know, to take it even a step further, if you were retired, no longer saving, and you were invested, largely in stocks and you lost 40% of that money, and you're not being able to put more money in to buy at deflated prices. Whereas a young person, if they're 100% in stocks and it goes down 35%, yeah, it's not fun to look at, but they're still earning money and saving on a month-to-month, paycheck-to-paycheck basis, and they're buying stocks, when we call them on sale. It's like if there's a downturn in the market, it's not a bad time to buy.
Yeah. I was going to say, buy low, sell high. That's everybody knows that part.
Yeah. And across all of this, you're trying to really match people's, needs with their present resources. And so, for a lot of people, they may not realize how much risk they can afford to take, especially in our area. I think every geography has their different mix between, someone who's more cautious or conservative, versus someone who's more of a risk taker, versus someone who's comfortable with delegating to that instance. I'd say the Tri-Cities has a little bit more of like a 45% delegate, 45% more cautious conservative. And then there's like this 10% small risk taker.
Go for broke.
Group. Yeah. But, for example, if someone has like a pension and Social Security benefits, they're covering the vast majority of their spending needs, like let's say someone who works at Hanford, then maybe perhaps they could afford to have a more, we would quote unquote, aggressive portfolio, a higher allocation to stocks than bonds than, someone who just has Social Security and that portfolio.
So would you say there's a con to the person who is very conservative, who is very risk averse in saying, nope, I want the most cautious, I don't ever want to see a loss type of a individual, they want to see a slow gain? Is there a negative or a con to that particular style?
Well, I think right off the bat, just kind of like mathematically, we're saying, hey, the baseline thing that we're trying to do is beat inflation. At least. So I'd say any plan that is losing to inflation over time should be off the table.
Yeah.
And then after that, my mentality is really like, hey, what is a portfolio or plan that you can stick with while at least beating inflation, and then while generating the greatest return, most capital efficient plan possible for the level of risk you can handle. Like some people need $200,000 or $300,000 in their checking account to sleep well at night. To me, that'd be awesome.
I would be happy with that. Yeah.
I don't need that much at this point. But then it's like, okay, if that's what you need, then your investment portfolio, still maybe it's a 50-50 balance and you still have that cash there. And if that's what it takes, then that's what it takes. But for others, maybe they can be a little bit more aggressive. And it's really just, laying out the entire field and explaining it and making sure that you're meeting people where they're at in your explanations. Be like, hey, this is actually how much risk you can take. This is how much, you're currently taking. And then this is what you're leaving on the table.
Going to say, do you regularly put like some scenarios, like if you were willing to take a little bit of risk and maybe this earns this much over this time as opposed to this much, you could be sitting here as opposed to here. Is this kind of that you could be here, it's your choice, or is this a more of a I shouldn't say a pushy sales pitch. We're not trying to sell somebody a new car, but is it kind of one of those, I want to see you guys do better, and you could by taking this extra amount of risk?
I look at it a little differently.
Okay.
It's very goals based. So I think my job, most importantly, is to help people understand what their goals are for themselves and their families, and then help them accomplish it. And if I feel that they are not putting themselves in the best situation to accomplish their goals because of what risk they are or aren't willing to take, I will make it known to them that, this is what you're missing out on, or this is why I think you might fall short. Once they get to a place where I'm comfortable that they're going to achieve their goals, now maybe we jump into that conversation a little bit, but it's so opposite, like you said, from a car sales pitch, right? Because I'm going to tell them, hey, you're on track. You're going to accomplish, you should be able to accomplish your goals, but can we make you have a little bit more flexibility if you were to do this? So I try to, instead of just making it a dollar amount where, hey, you might have this much when you get to age 80, you could have this much if you invested this way. It's more, well, would another year earlier for retirement make your life better, or whatever it might be? And I think that conversation is well received typically. I've been shocked at how little a lot of people care about how much money they have when they're 85, right? Most of them don't have. Maybe they want to leave a little bit to their family, but really
they're more interested in their lifestyle at that point in time, what they plan to do,
being able to sleep at night.
Yeah, I mean, and wake up the next morning, hopefully.
And hopefully wake up the next morning.
Yes. I think a big part of it is just making sure that people's the actions, the resources match the goals that they're talking about. And then, when trade-offs come up, just being honest about them. And some people just prefer to be more conservative with their investments than others. And that's okay as long as it still gets you to where you say you want to go.
Yep.
Now, we did talk about losing a decent chunk of an investment with a major market downturn or a major recession situation. Do you find that people really panic when that comes around, or are you able to kind of see people being like, well, this sucks, but it sucks for everybody, and we're going to make a comeback on that?
I would say, and I'll let Nick chime in on this too, because I've talked with him about this, and I think he's got a lot of good insight. But there are people who are going to panic. There's no way around it.
Yeah.
It is scary. I'm never going to sit in front of a client and say it's no big deal. Because yes, it's scary. It's not fun to watch, money turn into less money.
Yeah.
When it's supposed to be growing. But we focus a lot on expectation setting. And so we feel like for us to prepare our clients for the inevitable, because I'll tell you right now, we're going to see a market downturn. It will happen at some point. I don't know when.
Yeah.
And so we don't just tell people, hey, some years it's going to go down, some years it's going to go up. It's walking them through with whatever sum of money they have, how it's invested, that this is what it would look like if this happened. And that, I think, gives us better reactions from clients when the market does go down, because we've prepped them for it. We talk about it every year. And it also helps us help the client make better decisions in those downturns, because they're less scared. So it's managing emotions again.
Okay. Less the actual investment management, more the person in management being like, well, we planned for this.
Right.
Because we have an idea, we have a strategy.
Exactly. Yeah. Because we invested you appropriately, we're comfortable. And hopefully you should be too.
Yeah. Well, and then part of that expectation management, I think, too, is, we talk about investments in percentages, but we feel the results in dollars. So when talking to clients, talking to potential clients, part of that understanding of their risk tolerance is, translating that percentage to dollars. It's like, hey, if you have a $500,000, retirement account, here are the range of possibilities over the past 50 years of history that we've seen in a portfolio invested like this. How would you feel if next year we met again and instead of 500,000, you were down 20%, so now you have $400,000? Like, what's your reaction to that? Like, are you going to stick with the plan? Are you going to want to make like a dramatic change? And just walking people through that process. And then once we've committed to a portfolio each year, and more than each year if necessary, just walking through, hey, we're reviewing once again the expectations for an investment of this type.
Last time we met, we talked about this.
Yeah, we talked about this. And then also going over like how the different asset classes we'd expect to perform. Really, the major distinction would be how would the stocks perform, how would the bonds perform. So even if the stocks are down 20%, you're still most likely not going to see much of a change at all on the bond side. Plus or minus a little bit. 2022 is a weird year where the Federal Reserve really raised interest rates, which caused your intermediate bond index to go down 13%. That typically does not happen. But yeah, just going over what they can expect.
So these expectations, what you're doing at this point is really setting what you guys feel in a client is a healthy mindset for their investments, for the market. And basically setting those expectations for potential volatility and all the potential outcomes. Because again, if Nostradamus existed, he would be the best investor ever. But there are enough prognosticators out there that are saying one way or another, meaning multiple outcomes are always the potential.
Yeah. Exactly. And then it's not only are we just, considering, hey, what are the range of outcomes? There's game plans attached to those to see like, hey, what can we do if this event happens, whether it's taking advantage of a tax planning opportunity with Roth conversions, rebalancing the portfolio. So, so technically when stocks are on a decline, technically they're not on discount, but if you believe that, we're going to make progress in the future, that long-term mentality, we're saying, hey, they're temporarily discounted. We think things are going to get better. Why don't we add more to that side of the investment pool?
Yeah, that's the I spent $100, but it's regularly $200, so I didn't lose $100 in buying this thing. I actually saved $100.
Yeah,
that shopping mindset that you can get. If I hadn't bought it, I wouldn't have lost any money or wouldn't have spent any money. But we expect it to go back up at some point, and so buying at a quote unquote discounted price, buy low, is a great time to get in, and especially if you expect things to rebound.
And I'll add one other thing, Scott, just because recent history in the stock market has been like very quick. So we had like a temporary 30% decline during COVID, and by the end of the year we were back.
Yeah.
2022, same thing, down 20%. Within eight months or so, we're back.
Yeah.
Sometimes buying at those depressed prices, it takes multiple years for you to really see the benefits of that. So if you're thinking like post 2008, there was times where we're like, hey, let's add more to the portfolio. And then the market went down further. But
meaning another great opportunity to add more to the portfolio.
Exactly.
So when it recovers that much better.
That's the market mindset.
Yeah.
But really it's 10 years later where we're like, oh, that was an excellent decision. Maybe it didn't feel good at exactly that moment or when we saw it go down a little further. But
like we said at the very beginning, we're talking 30, 40, maybe even 50 years of projection and riding these waves in the market in order to see that our goals for our future self come to fruition.
Yeah, no, exactly.
So calm decisions, try to avoid the chaos mindset of we have to react, we have to do a thing. I appreciate the whole, you guys know better than I do, so I'm going to let you guys work those decisions and maybe ask me if I'm cool with a thing here or there, which I'll probably be like, yeah, definitely. If that's what you guys think is the right move, let's do that. Final thoughts as we get ready to close this out, this particular episode. What do you guys got for me?
You want to start?
Oh, okay. I'll start. Yeah. So, for me, my final thoughts are, the long-term mindset really starts today. You don't have to start new routines on January 1st. You can do it anytime. And it's really just once you've made the decision to commit to a routine, just sticking to it for the next 5, 10, 15, 20, 30 years. And if you ever need a second opinion or want to be able to delegate that decision-making or thought partnership to someone else, most financial advisors are willing to meet with you at initial meeting of no cost. We'd be happy to meet with you. Other people throughout the area would, I'm sure, as well.
Yeah, and February 1st was yesterday, so it's just as good as January 1st, right? To get going. No, I think I've been pushing this a lot with clients, potential clients, friends, family. Is start small if you must, but just start. It's a saving mindset. I think we touched on this maybe in the first episode.
We did. Yeah.
It's amazing what $50 a month turns into or $100 a month turns into in a year if you just put it away, and that builds confidence. So, I'm a firm believer that, if you just stack small amounts of money, for a year or 2 years, you'll start to get encouraged. And once you're encouraged, it becomes a lot easier to continue to stock it away and start, hopefully investing for your future. So.
Yeah, compound interest is a amazing thing when you start seeing that snowball roll downhill and pick up momentum.
Right.
It makes you kind of feel like you want to add a little bit more here and there.
Right.
And like I think last episode we talked about, if you are not investing early on, you're probably leaving money on the table, especially if your company has a 401k matching program. If you're not immediately invested into that. Those are
certainly.
great places to start for anybody out there who has those opportunities. And adding in additional investments and whatnot on the other side is fantastic. And I think the other thing that we talked about today that I want to leave people with is if you really feel like you want to react to all those headlines, go get yourself a Robinhood account or get yourself set up on E-Trade and set some money aside that you can play with, but don't ignore having an actual investment for your future. If you want to play, maybe stocks are your thing, and it's not Spanish 21 or blackjack at the casino, and you're going to get better returns by investing that way, or it's going to keep you out of messing with your future investments. Having that fun slice of money that you can play with and really get in and let yourself vent that way so that you can leave the other investments to that nice, steady approach.
Exactly. Robinhood is probably not going to be the core of your retirement plan.
Gentlemen, thank you for coming back on the episode again. We look forward to the next time we have you. I will see if we can get Jeff to bring us in a nice horn or buzzer for our next market updates and the amazing top 10 stocks that we'll talk about next time.
Exactly, yeah.
And until then, this has been Dollars and Cents, Hapo Community Credit Union's Financial Literacy Podcast. Until then.